Great. Thank you all so much. I know many of you came for this session and this session alone. We've been told people are coming to hear Bill, so we are fortunate to have Bill with us, and we got some good questions for him. Although he told me I covered it all in my speech, which I take as a huge compliment because it means I was saying smart stuff if I was going to say what Bill says. So I think to start, probably what most people want to know, Bill, is your thinking on the markets and the economy. There's a lot of bearishness out there. I think Stan Druckenmiller was out a couple weeks ago talking about the problem with debt and interest rates and not ruling out a financial crisis. Warren Buffett and Charlie Munger talked about lower returns going forward for the markets. You've joked, as we said earlier, about being bullish, either bullish or very bullish. Is that even possible right now? Are you bullish or very bullish?
Yeah, both.
Good.
So I think there are a couple of things that are really important to understand in markets, and probably the most misunderstood one is people believe that the economy predicts the markets. That's why we're going to have a recession. What's the growth rate going to be? What's inflation going to be? That's not right. The markets predict the economy. And so that's what you're reading in is the expectations of the markets right now. And now, in terms of actually understanding the economy, I do remember in 2008 I was with Warren out in Sun Valley, and he said everything stopped in June. This was in July, and I think that was he was totally right. He has both short cycle and long cycle businesses, and when he said at the annual meeting a couple of weeks ago that Berkshire's businesses outside of insurance will have lower earnings next year, he's pretty much telling you that we're either in a recession right now or we're headed into one, because those businesses, he's obviously been doing this for about 70 years, and he understands those businesses well, and he very rarely makes calls like that about what's going on. So I think, though, that one of the questions, if you look at expectations, the market has been remarkably resilient since October. It bottomed in October. Most stocks bottomed in October. And with all of the talk about debt default and everything that's going on, the fact that it's hanging in here, the S&P is hanging in here at around 4,000, I think is quite telling. And so the other thing that I think it's important to remember is that the Fed has no idea what the economy is going to do. And it's not because they don't have they have 300 economists there studying it all the time. The problem is that those 300 economists are smarter than every investor in the world who has real money at risk. I went down to see the Fed in the fall of 1981, fall of 1982, and I went down to see Preston Martin, who was then the vice chairman of the Fed. And he said, what can I, how can I help you? What can I do? And I said, well, the stock market's bottomed in August, and it's had a huge move, but the economic data continues to come in weak. The unemployment rate, is still high. It hasn't come down at all. And I said, do you think that the recession that we're in is over? And he looked at me and he said, what do you think? And I said, well, Governor Martin, I didn't come down here to find out what I thought. I said, I found what you thought. And he said, well, what you think is much more important than what I think. He said, not just you personally, he said, but you collectively. He said, because you actually have real money at risk, and if you're wrong about stuff, you're going to get fired. And he said, we're appointees, we can't get fired. And so then he proceeded to say, when Paul Volcker took over, what Paul said was that we need to pay much more attention to what the economy is doing, what the markets are doing, and less attention to what we think we should be doing. And I think that was a big change that Volcker made. And the result of that has been in that 40 years or so, the Fed basically follows the markets. They don't lead the market. They wait till the markets tell them what's going on. And I agree with Jeff Gundlach that, this is the last thing to say about the economy, I think, is that Gundlach said he doesn't understand why these 15 members of the Fed's Open Market Committee think they can predict the market. He said they've been consistently wrong. You can see their dot plots. They haven't been close to being right. They're wrong about inflation. And historically, they've been late to recognize inflation, and then they tighten too much until things crack up. And he said we should just get rid of the Fed and allow monetary policy to be driven by the 2-year note. And I think that would actually be an improvement.
Okay, great. So my next question,
let me get the key point here about bullish or very bullish.
Okay.
So casinos are very profitable businesses, right? So properly run, and their edge is about 2 or 3% on most of those games, right? So maybe if 52 to 48 or something like that as a percent. your data, which is exactly right on the markets, it's 70% of the time the market goes up. So why would you ever try and guess the 30% of the time that it isn't going up? You should just forget about that. It's going to go down when it's going to go down, and that's the time to buy more of it. So it's one of those things where I think it's plainly irrational based on the data that to try and think about things without thinking about that.
But Bill, I think what's hard for people is to stomach that and to feel the loss, obviously, if they buy and it goes down. Do you feel that? Is that a pain you feel?
No. No, I mean, I do think that I do think that my mother dropped me on my head when I was about 6 months old, and it scrambled my brain there. But in the fall of 1987, the market was began falling in August, and the Washington Post interviewed me about 5 days before the crash, and they said, "What are you seeing here?" I said, "I'm seeing a lot of good values that I haven't seen before," and he said, "Well, but the market's falling." I said, "But the lower the stock market goes, the higher the future rates of return go." So the market crashed, right? And then they had a follow-up in the Post, and it said, "Well, Mr. Miller must be gleeful now because the market has just crashed and everybody's out of money." When I was actually earning, and I put all the money. We had 25% cash going into the crash, and we got it all put to work in the next 2 weeks, and we were the #1 fund in 1988.
That's amazing. Speaking of Mr. Keeney, this wasn't on the list of questions, but I'd love you to channel that optimism that he used to bring. I know you can do this, and share with us some observations of positive things in the world broadly. Are there any things to note about how the world is? We hear about AI and the potential devastation of that, the climate. I mean, the list goes on, but you don't hear much about.
Well, you had the quote from Warren up there. What happened from 1900? I mean, it's basically the case that nobody comes to work every day and says, I want to do dumb things today, and I want things to get worse, unless they're short. But basically, everybody comes to work and they want things to get better. They want to do better in their job. They want to go. So you have the entire population, working population, trying to make things better, and so that's why things get better. There are always problems and there are things that go wrong, but that's the underlying dynamic. And you can look at the companies that didn't even exist 25 years ago and what they've done. I think AI is it's different, but I think it's going to be the same thing. It's a little trickier, but because you're never going to get it regulated in the sense because China will control theirs, and they're not going to stop doing it because we don't want them to do it.
Yes, the optimism. I think one of the things I remember Mr. Keeney being so optimistic about. He loved some of these small biotech companies, and Celgene was one, and he talked about the cure for cancer coming. And I think we're so much closer to that today in terms of the personalization of medicine and data on the genome that I think he would be very excited about that. So one of the things
I just want to say one thing about the economy again, which is that the 6-month rate of inflation is about 3% right now. So we've already had inflation coming down, housing prices everything's coming down. All the leading indicators indicate that you're probably looking at 2% inflation, 2 to 3. And so that's going to the Fed is going to have to respond to that once, but they're looking at the lagging indicators, and the reason they're doing that is not because they don't know that those are lagging indicators. They're doing that because once the lagging indicators have already shown inflation down, they will have nailed inflation. But the one thing I think that people aren't thinking enough about is that in the 10 years after the financial crisis, the Fed had a 2% inflation goal. And in those 10 years, they had 2 quarters where they got to 2%. So there were enormous deflationary forces out there that were operating post that period. And right now, it's the case that you've had inflation come up, and that was, a couple people got that right. Jeremy Siegel did, Larry Summers did. And they were looking at a variety of things. Larry's looking mostly at government stimulus, and Jeremy Siegel was looking at M2. But M2's crashed right now. And so it's going to be very, very difficult for inflation not to follow that into that pattern. And I think so you're going to look at a very different situation in the next 6 months.
So I agree with that. So one question, Jamie Dimon on Monday at the JP Morgan Analyst Day, Investor Day, was talking about how he's counseling all companies and all people to be ready for much higher rates, both at the short end and the long end. And he said, and we're not talking about 375, 425. We're talking about 5, 6, 7% rates on the long end. I don't see how you get there without inflation Do you think it's possible without inflation remaining a problem? What do you think he's looking at? What is he thinking?
I think he's probably looking at the history of the inflation that began, in the 70s and then continued on, through 79, 80, 81 until he really squeezed it down. I just think it's a radically different time right now, radically different economy. And again, the forward-looking indicators are not saying that, and the market's expectations are not saying that. And again, I would say the market probably knows, the collective market probably knows the future better than Jamie does.
Mm-hmm. And what do you make of these? You hear a lot about some of the inflationary forces out there, whether it's the labor force and the retirement, the demographics, or the switch to green energy. A lot of things. I saw an article in the FT this week on PFAS and getting rid of the chemicals that were going to be inflationary for semiconductors. So it seems like there's a lot of little individual inflationary forces. Do you think they're material? They materially change the inflationary outlook? Is it just too hard to tell?
Yeah, I would say one of the things that I've learned over the decades is that making forecasts is useless. There are no forecasts which are remotely accurate, and you can see. I mean, how many people say, "Oh, there's going to be a war in Ukraine, and there's going to have this pandemic"? Like, no, that's there's nobody has privileged access to the future. You know what the history's been, but you don't know what the future is. And I would say the markets are the best predictor of the future. And if the markets aren't telling you that there's an issue here, then there's probably not an issue there. Now, again, as I think Paul Samuelson said, the markets have predicted, 9 of the past 5 recessions. But so the markets aren't perfect, but they're better than the alternatives.
And I think when we went back and looked, Warren Buffett's annual letter after 2008, he talked about the risk of inflation then. I know people were very concerned of it even back then, and we had the opposite problem. So you've mentioned before that not many people were investing the last time inflation was a problem in the 70s. You were. It was a very different environment. When you reflect on the past 50 years, what about the investing environment is the same, do you think? And what has changed?
Well, what hasn't changed and what makes the markets the way that they are is human nature hasn't changed. So people, a loss of $1 is twice as painful as a gain of $1. So the coefficient of loss is 2 to 1. And so what that means is that as people lose money, they get more fearful, their time horizons shorten, and they react to try and take that pain away. That's what makes, makes bear markets and what makes bottoms in the overall market. And again, people are wired to like stuff that's going higher and when they can make money quickly. So that's the thing that hasn't changed, and I think that's the thing that you can arbitrage, over and over and over again. What has changed is the markets are much faster to react. Not just because of social media, just because of quantitative trading, algorithmic trading, risk parity, all of these other things that didn't exist or existed in much smaller ways back, in the 1970s and 1980s. So they make stuff happen much faster. Stuff gets discounted much faster. I mean, there's stuff, Doug's talking about OneMain. I mean, and again, it's not impossible that OneMain could lose money in a very severe downturn. But, if the dividend is secure as it is and the balance sheet's so strong, the dividend alone will have you beat the market, even if the stock doesn't do anything, 10% a year. And they'll be raising it gradually, and they're buying back stock. And it's hard to see when they've got let's call it a 20 to 30% return on equity. And JP Morgan's the most profitable of the big banks. It's got about an 18% return on tangible common equity. And most of the others are considerably lower than that. Why would it trade at double, or more than double, the valuation of OneMain? And OneMain is a company that used to be way back when. It was the precursors of that were household finance and beneficial finance. And we owned those in the early days of the value trust. They always traded 10 times earnings. When they were expensive, they were 12, and they were cheap, they were 8. And this is now, 4. That's where the opportunities are.
Mm-hmm. Yeah, it's amazing how ignored it is. People just don't care. That's not what they're interested in right now. People still like the growth stuff.
Well, people basically say, oh, the market's PE is whatever, 18 or 20, and really it should be 12. Well, who cares? I mean, what's the point of that? Unless you're, I don't know what you're trying to do if you're saying that, except trying to talk yourself out of being invested in stuff that you can make money in.
Yeah. So you've mentioned, and it's come up, this loss aversion and how painful that is for people. And I think if you look at some value investors like Warren Buffett or Seth Klarman, they talk about the first rule of investing is not to lose money. And the second rule is don't forget the first rule. And you've had a different philosophy, which is it's not about losing money, it's about how much you make when you're right, less how much you lose when you're wrong. Can both of those things be right simultaneously? And do you disagree with their view on avoiding losses at all costs?
Yeah, because you can't avoid loss. So, I mean, Warren writes eloquently over the past 50 or 60 years about, he buys World Book Encyclopedia, goes to zero. Right? He lost money on that one. So he's lost money on a lot of things. I think it's a nice, avuncular statement to say the first rule is this and the second rule is that, but you can't avoid loss. I also think that the actual facts are that most people are too risk averse. So that there was a guy in Sweden who bought some Bitcoin a few years ago, and he put it on his balance sheet, and he was running a conglomerate sort of like Buffett, and they said, well, isn't that risky? And he said, well, in what way? And they said, well, couldn't you lose, you could lose that. And he said, oh yeah, I could lose that, sure. And they said, well, why would you do this? He said, well, you're missing an important part of risk. And he said, without taking great risk, you can't have great rewards. And I think he said, so people are looking at the wrong side of that thing. You're going to need to take risk if you're going to have big returns. I think actually, didn't the head of NASA say that, Heather, when the SpaceX blew up, right? He said, we need these kinds of things to happen to helps us move forward. And he made that same statement about there aren't going to be great rewards without great risks, I think.
So on that topic, you've had a number of 50 baggers. Not many people, I don't know if it's harder to find them or hold them. Both are very difficult if you're an investor.
It's much harder to hold them.
I think so,
Yeah.
yes, for
you
sure.
Can go back. One of the things I just say about that is that if you go back and look at 10-year chunks in the market, so, and I did this, I would say, okay, what were the best performing, I would say groups, but it's actually stocks for the 70s, the 80s, the 90s, the 2000s. And typically those best performing stocks come from basically one or two industry groups, because there's been some big change going on there. So in the 70s, it was oil and hard assets and stuff like that. In the 80s, it was consumer products companies, when Heather was an analyst at JP Morgan. In the 90s, it was tech again. So you had a bunch of different things, and they tend not to repeat. So it took the aughts, I guess, when the China boom happened for oil and gas and all to come back like it was in the 70s, and then what did it do last year after that crashed? So now it's kind of in the middle. But the point is that there are all these. The other thing is that the best stocks of the 90s, yes, were Dell, Microsoft, Cisco, companies like that. They were up 10,000%. Now, how many people actually owned them and made 10,000%? Very few. So I think that's the other thing is it's much harder to keep owning them than it is to find them.
Yes, I agree. And I guess in the current environment, when so many of us are looking at the past couple of years and saying, well, why didn't we sell out of that thing? It was so, hindsight bias. It was so clear. But the other side is you want to let your winners run. So how do you balance those two things and have valuation discipline and sell when something reaches a fair value versus letting it run?
Well, first, I think you have to have a sense of what fair value consists in. And it's a range of probabilities. It's not a single, it's not a single number. But you can come up with that. And the other thing is, I think you have to look at very large addressable markets. And so, when people have said to me, "What's the best investment decision you ever made?" It was buying Amazon in the IPO. What's the worst? Ever selling a share of Amazon. I mean, Amazon had its 26th public anniversary last week, and it came public at split adjusted for the current price, 7 cents a share, and it's $115 a share. And so, one of the things that unfortunately is the case in both the institutional investment business and in the retail investment business, mutual funds, is that effectively either the government stops you from making that kind of money because they won't let the funds own more than a certain percentage of their assets in particular industries, or if you're an institutional investor, it's your clients or your investment committee that also gets really worried about stuff, getting too big a percentage of the portfolio, and thereby putting too much volatility into it or risk into it.
Yeah, and it may seem easy now to look back and you look at the chart and it looks like it's a straight line up, but Amazon lost 95% after the tech bubble burst. And I think you got a lot of flack. Was it Bruce Greenwald at the Columbia Value Panel berating you for how could you possibly invest in this thing as a value investor? Did that shake your confidence?
Yes, Bruce is kind of the guru of value investing. He's retired now, and he ran the value program at Columbia. And so on the I guess the anniversary of the reprinting of his book on value investing, he had a value investing panel that Glenn Hubbard, who was then the head of dean at Columbia, put together, and it was Seth Klarman and Mario Gabelli and me and somebody else, I forget who it was, and so Bruce got up and so they had some questions for us, and then Bruce got up and proceeded to berate me and said I wasn't a value investor. He didn't know why I was even invited to that, and that anybody who could own Amazon, not only weren't they a value investor, they didn't even know what they were doing. And he proceeded to explain to the whole audience about how Walmart will put Amazon totally out of business, right? Totally out of business. And to Bruce's credit, a few years later, they had this Graham and Dodd breakfast where they have a cast of thousands there, and he said he got up and I was the interviewee, and he said I'll tell you that. And he told this story about how he said I wasn't a value investor and didn't know what I was doing, and he said, and there's a lesson for this. He said, which is that when a professor tells you that something is not going to work based on his theories about how things work, and a professional investor who's got real money on the line takes the opposite position, go with the investor who's got real money on the line.
Did that shake your confidence at all to be that have that much question, or have the stock go down? People were saying it was going to go bankrupt. People are questioning.
Okay, so I'll just elaborate a little bit more on what happened there. So because that was so startling to everybody that he was attacking me in public, Glenn Hubbard said, Bruce, would you mind if Bill would come up and tell people why he owns Amazon? And Bruce said, sure, go ahead. So I got up and I said, well, I'm not going to talk about Amazon. I'm going to tell you what Amazon is like. I said, Amazon is basically Fannie Mae. Yeah. And of course, everybody goes, what? And I said, so when I got into business, someone who knew Peter Lynch got me to talk to Peter and said, yeah, I'll talk to this guy. And I went in to see him at Fidelity, and he's running the Magellan Fund, obviously, and the most successful portfolio manager of his time. And he said, oh, yeah, you guys at Legg Mason, you have started a fund, right? I said, yeah, we started a fund, about a year and a half ago. And he said, do you have your portfolio? And I said, sure. So I give him the portfolio. He's like, wow, this is a really good portfolio. He said, you got your banks, you got your savings and loans, you got your autos, you got your early cycle apparel stocks. And he says, but where's your Fannie Mae? And I said, Peter, I've actually looked at Fannie Mae and I couldn't figure it out. And I said, and I actually talked to some of my colleagues and they said, oh, it's way too complicated. And he said, oh, it's my largest position. And he said, would you like me to explain it to you? I said, sure. And he said, we got banks in there, right? And I said, yeah. He said, well, Fannie Mae's a bank. He said, except it doesn't have any branches. So it doesn't have any branch costs. He said, it's got one branch, one building down here in D.C. And he said, and it doesn't take any deposits. What it does, it gets its money from the capital markets. And he said, and it's because it's a quasi-government guaranteed institution, it borrows just a little bit more than what the government borrows at. And then it takes all that money and it invests it in the same stuff that banks do, in basically mortgages. And he said, oh, it's got an insurance business where it also insures those mortgages. And so he said, so it's got a lower cost of funds than all banks do. It's got a lower overhead than all banks have. And he said, and it's got the same rate of return that banks are earning, profits on, and it's got an insurance business, which is a really good business. And I said, well, why does it lose all this money then? Because it was reporting vast losses. And he said, well, that's for you to, I've explained it to you, now you go figure out why it's losing money. So I went back and I, spent about 4 hours reading the stuff and the footnotes. And I called him up and I said, is this thing really trading at 1 times what it's going to earn in 3 years? He said, you figured it out. And we made 50 times our money on it. So I basically said to the Columbia group, I said, Amazon is Fannie Mae. It's basically got, it basically got much lower cost. It doesn't have all these, at the time anyway, it doesn't have all these things like Walmart has, these warehouses and stuff like that. It doesn't have all these employees. So it's using technology. And that was I said, I also said, it's also like Dell. It's a direct-to-consumer business. And it can expand in a wide variety of ways people haven't thought about.
And so it was a true compounder like Fannie Mae. And if you look at Warren Buffett's evolution as a value investor, he says he started with the cigar butt investing, like picking it up and having the last puff off some free thing, and evolved to a preference for buying wonderful businesses at fair values rather than fair businesses at wonderful values. But
Both of those are good, by the way. You have to do one or the other.
yes. And so now I think, and I mean, one of the things I learned the most, I came to you and I liked classic value stuff that was down. So I hadn't thought about the idea that you could make much more with great businesses that could compound over time, and you were criticized at the time for that. Now I think the environment has shifted so that everyone prefers that style of investing. People like David Einhorn are questioning whether value investing is dead. We saw the relative valuations of some more pedestrian value companies relative to some companies considered to be compounders. What is your thought on the future for value investing? And is this compounding thing been taken too far?
No, I think that you mentioned Howard Marks and that sea change thing. I mean, that's been my view, which is that it's a regime change, a different environment now from what we've had before. I wouldn't rule out, though, it going back the other way. But I will say that in this current environment, as long as the Fed is doing what it's doing, it looks like it's going to pause. But obviously, as you raise rates, it reduces the present value of the future cash flows of businesses. And when real rates were negative for so long, those future free cash flows were worth a lot. And also, my friend James Anderson, who was just retired from Bailey Gifford, who had a brilliant record, but I mean, one of the things that led him to think differently about markets was figuring out a reading of this academic literature that going all the way back, only under 5% of the companies in the market actually earn excess returns. So if you're talking about that, I mean, how are you going to find the 5%? And you're going to probably get a lot of them that don't do that. Other ones that don't do it, in fact, most of them actually are negative rates of return on a real basis. So I got James to basically focus on true innovators and stuff that he believed would have massive addressable markets and not worry too much about what you're going to pay for it. But that went too far, and now we're coming back. We're coming back the other way. So, but I think, and OneMain's a perfect example. Mattel is a no-brainer in the sense of I mean, Tyler mentioned, you can clearly see that if they merge with Hasbro, which I think that they eventually will, because the toy industry the entertainment business is much bigger than just the toy business now. And so I think those things, they talked about that in the past, both the companies, but the FTC wouldn't allow it. And I would guess it probably would allow it now. But you've probably got at least a 3 or 4 bagger if that happens. They take all those excess costs out. Or if it's private equity, we'll pay at least 50% more for it.
So one of the quotes that you introduced me to was by Puggy Pearson on gambling, the famous gambler. And I think it applies to investing, but it said, ain't only 3 things to gambling: knowing the 60-40 end of the proposition, money management, and knowing yourself. So which of those 3 do you think is most important and most difficult for you and for investors broadly?
So I think the late Puggy Pearson was exactly, all 3 are important.
Yeah.
I would say I'd say all 3 are important. Probably the first one is the most important, just because you have to have an edge. If you don't have an edge, you're not gonna make any money. The third one is probably the second most important, because if you fritter away your edge, or if it goes down, or you get scared, then you'll also not do it. And money management is kind of optimizing the basically how you're thinking about the growth rate there, and so that's there's as you probably know, I'm sure you know that. You may not know this, but there's a so-called Kelly criterion, which would tell you how much to allocate to particular assets based on the confidence that you have that they're going to work out. So if you had 100% confidence, and assuming you're right, had 100% confidence in something, how much money should you put in it? All of it, because you're going to make a lot of money. And if you have no confidence, you shouldn't put any of it in there. And there's a formula to do the thing. But I would say that's the money management. It's more optimizing. Now Warren, I also think that Warren is right when he said when he looks at his entire history, he's made a good decision about once every 5 years, in the sense of good, meaning that they just swamped all the other decisions, and most of his things worked out a little bit or didn't work out a little bit, but there were a couple of monster home runs, and I think that's the I mean, that's the thing with Amazon. I mean, I think in fact, I'm confident that I'm the largest individual owner of Amazon, personally, who is not, his last name isn't or wasn't Bezos. And I did have a conversation with Jeff about that when I figured that out a few years ago. And I said to him, he got angry with me. I said, hey, Jeff, I'm looking at your proxy, and is it right? And he's like, is my proxy right? What are you talking about? Is my proxy right? And he said, in what way do you think it's wrong? I'm like, I didn't say I think, I was just asking you. I said, but I see all the officers of Amazon, and I see what their options holdings or their restricted stock holdings are and their direct holdings are. And does anybody else at Amazon have more than them? And he said, no. And I said, well, then I own more than anybody else except for you. And it was then his wife. And so, but that was due basically to when Amazon, went down from 98 to 6, pre-split. We just bought it all the way down. I bought it all the way down. And then when they had that, some years ago, when it went in half and we bought all those call options.
Yeah, 2014.
2014 in the fund, I bought call options too. Mm-hmm. But I exercised them and held it. And I've just bought a lot more call options just in the past month in Amazon because it was down from 180 to 82 back in the fall. That was lower than it was during the pandemic before people figured out that it was going to be a beneficiary. And now it's 115. And somebody actually today was up in a down market because somebody said that they were calling the bottom in AWS's growth rate, meaning they thought it would bottom this quarter. Yeah. And which I think is probably right. And then they said that AWS already is a big lead in generative AI, and which I have no way to judge that. But I do know that when they came out with Alexa and stuff like that, when they did AWS, I was talking to Bill Gates and I said, did you guys see this AWS thing coming? And he said, not when it came. he said, we're working on the same thing. He said, but somehow or other, Jeff seems to get the jump on us on all of this stuff.
So what do you think of Jeff versus Andy Jassy? Andy seems really good. I think we think very highly of him. How much is Amazon missing from Jeff being less involved?
Not much. I mean, Jeff's still the executive chairman. Yeah. And I know I gave a talk to the board a year or so ago. And I mean, Jeff was very engaged. In fact, when the board meeting was supposed to end and they were supposed to go into executive session, and Andy had said, it's time to go into executive session, and Jeff said, no, I want to keep doing this. I want to keep hearing these presentations. So we went on for another half hour. But I asked Andy that question. I said to him, so what's the difference between you and Jeff in terms of management style, anything at all, in terms of drive or whatever? And he paused and he was trying to think about what the answer was. He says, we're very much alike. He said, I guess I'm just nicer than Jeff. he said I'm not quite as intense and in your face as he can be sometimes when he gets mad. So.
That's funny. That reminds me of J.P. Morgan's analyst day the other day when Jamie Dimon was talking, and he said, at some other meeting, someone asked about leadership and leadership qualities and how he shows gratitude to his direct reports, and he said all the direct reports burst out laughing. He's like, I'm not the best at showing gratitude. They know I appreciate them, but that's not really what I do. He then showed some gratitude. So Bill, to shift a little bit to some more maybe personal topics, you have... Yeah, I'm going to ask. So you've taught the world so much and brought such a unique perspective to investing. You did the 15-year streak that no one else has ever accomplished, and most knowledgeable people think no one ever will because it's a great combination of skill and luck. So when you think about your legacy and you think about what's most important to you in 50 years, if you could be remembered for one thing or have imparted one lesson to the investment community, what would you want that to be?
I would just say be rational. I mean, I think that emotions are the most destructive thing with respect to investing, and just not looking at what the facts are and getting too caught up in the short term, in the short term day-to-day stuff. I mean, I'm not really interested in a legacy, but I do think that I think that that's the most important thing, that from an investment standpoint. Because what happens, and again, I've been on investment committees, and one of the things that happens is when you propose something that's different, then one of the first questions that either the head of the committee or the chief investment officer says is, well, what are our peers doing? Some on the Hopkins committee. So, well, okay, what are Harvard and Yale and the other top 10 schools doing? And if they're not doing it, then, well, why would we do it? We could look bad. And except if it works, then it looks great, right? And that thing, a quick story on that. So David Swenson, who I think you spent some time with Swenson, but the head of the Yale Endowment for 25 years, and the chief investment officer for 25 years, and the best, by far, in that group. And he was a very independent thinker, and he invested in stuff that other people didn't or wouldn't, like venture capital particularly. And I remember in 1999, at the height of the dot-com bubble, I was at a meeting, and Swenson was a speaker there, and he went over the record at Yale. He says, we've made most of our money in venture, and he said, and for the past 15 years, we've averaged 25% a year in our venture portfolio. And he said, and now, he said, and of course the venture funds are raising huge amounts of money because everybody's done well, almost everybody's done well. And he said, I would guess that they won't make any money in the next 10 years because the prices are crazy right now. And he said, and even the venture funds won't put their own partners' money in their funds. Mm-hmm. And he said, so if they're not going to do that, then why would? So we've got our venture portfolio way down. We've been selling like crazy in it. And then after the financial crisis, I was appointed to a commission that Swenson was on, and I'd just seen him speak before, but I hadn't spent time with him. And so he was seated right next to me, and I said, "Oh, David," I said, I'm a big fan. You've done such an incredible job at Yale, and I said, Yale is so lucky to have had you. And he smiled. He said, "Oh, thanks. It's great. Thank you very much." And I said, "And you've probably destroyed more value for more universities than anybody in history." And he looks at me like, "What?" And I said, "No, because you've done so great. You were an early adopter of everything, and everybody else follows you. And they were the ones that had put in the money in the venture funds in 1999, and they're the ones that are going to, doing all this other kind of stuff. And you're out doing the other stuff because too many people are worried about what's going to look good or what's going to look bad."
Yeah, and when I met with David Swenson, I was lucky to hear from someone else in attendance here today that I wasn't the only one, but David Swenson was berating me for investing in financials, saying you couldn't understand them, you couldn't analyze them. Lou, who's in the audience, he did the same thing to him on financials. So I guess you would disagree with Swenson on that, your ability to invest in financial companies.
I guess he wouldn't. That's a pretty broad brush, right? Financials. So Berkshire Hathaway's a financial.
Banks,
right?
Yeah, maybe.
Banks, yeah.
Yeah, consumer
Totally.
credit company. So the other question we get a lot, which I'm a little scared to ask, but I'll ask anyways. People want to know why I'm taking over for you, and then that question about similarities and differences. So why am I taking over?
No one else wanted a job.
I knew it. I knew. There was no controlling him. So the last one standing. I will actually take that as a compliment because Bill has said that this was not the most motivational speech about staying in this business as a career, but he said what defines success in this business is just surviving because so many people don't survive. So I guess the fact that I've survived to take it over. That's what you mean.
That actually is when I used to get asked, well, who do you admire in the business? Anybody that's survived more than 20 years, and I was at a meeting in London some years ago, and the guy seated next to me at the dinner was the senior editor of the FT, and he said, "Oh yeah, I've heard you say that you admire people that survive," and I'm like, "Yeah, that's right." And he said, "How long do they have to survive?" and I said, "Well, I said I normally say 20 years." He says, "No, not long enough," and I said, "Okay, what?" He says, "Well, I've actually looked at this." He says, "We said the different kind of question is, who has skill and who has luck?" And he said, "People can have enough luck that they can survive for 20 years." He said, "But 30 years, they can't." So there hasn't a single person when he said he actually did a study of this and had academics look at it and stuff like that. So, but you're well on your way. You're good.
That's highly problematic for people who are trying to pick funds and managers, right? If you have to have a 20-year track record, that's
Yeah, most of them don't make it that far. Yeah, that's for sure.
your work is never done. So, a couple final questions. What's the best advice you've ever been given, both in life and investing? And if you were to think about giving people advice in both those areas, what would you?
A couple things come to mind. Ernie used to, my late partner Ernie used to always say that more baseball games are won on 3-run homers and sacrifice bunts, and that's correct, by the way. And but the point being that you tend to, if you're not looking to hit home runs, you're not getting any home runs. And if you're just trying to, he also say you can't get rich making a couple points in a bull market. Mm-hmm. So you've got to basically look for the big winners, and they will. They're hard to find, but they're out there. So I'd say that would, and then similarly a different point of view, and it's the same thing, is Jesse Livermore in Reminiscences of a Stock Operator, which I used to read every year until I had basically memorized. I haven't read it in a number of years, but one of the things that he always said was, he said the big money in markets is made in the big moves. Mm-hmm. So again, you've got to have big moves to make big money. You're not going to make it when it's going sideways typically, unless you get lucky on a few things. I will give you a sense of my psychology. You've heard this story before, but many people haven't. So I guess you get a question like, when did you get interested in markets? And you say, I guess I was in college, I took an economics course or something like that. Or no, I remember very distinctly, I was 9 years old, and I was living in Miami, and I came in, been outside, and I came in, and my dad had the newspaper open, and it was when they used to have stock tables in the newspapers, and it's just numbers across a page, right? Numbers. And letters. And I said, what's that? And he said, that's the financial page. And I was like, it doesn't look like the comics or the sports section. He's like, no, it's about stocks. And I said, what's a stock? And he says, well, look here. He says, see that GM? That's General Motors, and like Buicks and Cadillacs. And so he says, and I said, what are those numbers? He said, well, that's the price for one share of General Motors. And I said, well, what are those other numbers? He explained, okay, this is where it opened, this is the high, the low for that, and then the number at the end, he said, that's what changed for the day, from that day. And I said, what's that mean? And he said, well, see that 1 over 4? That's a quarter, that's 25 cents. So it changed 25 cents. And I said, let's understand it. He said, so if you owned a share the day before of General Motors, like it says $25, and the next day it'd be plus 1 quarter, you made 25 cents by having that share. And I said, what do you have to do to make the money? And he said, what do you mean? I said, how do you make it go up? He said, well, you don't do anything. It just does it by itself. I said, wait a minute. You can make money without having to do any work? And he says, well, sort of, yeah. And I said, well, I want to understand this because I want to make a lot of money, but I don't want to do any work. And so I left out. I'd been outside in the 95-degree heat in Miami with a little push mower, and I was covered, in sweat and grass for 25 cents. And I can go to sleep and make 25 cents. That's what I want to do. It did take a while to realize that you can make money just by buying an index fund without doing any work, but to earn excess returns does require a reasonable amount of work.
Yes. So I don't want to let you go without asking you about Bitcoin. You have your Bitcoin hat on. I don't know if you went to the recent Bitcoin conference, but
yes, sadly, I went to the Bitcoin conference. Cast of thousands. I was interviewed there, and I realized that I was the oldest person in that room by not by a little bit either. There might have been somebody else there. My son's 42. He was there, but that was about it. And in fact, there was somebody who sent me a text afterwards. There was a panel that was being held, and it was there's a woman whom I didn't know of named Lynn Alden, and she was on the panel. And my son informed me that she was very smart and did a bunch of macro stuff and was an engineer and stuff. And so I listened to her, and she was very smart. And so afterwards, she came out. I came up and said, I really enjoyed your comments, and she said, oh, thank you. And so we chatted a little bit. And there was a kid there who was probably about 15, right? And he comes up and he's standing there, next to us, And so finally when I paused, and so he says to her, "Can I have your autograph, and can I take a selfie with you?" And so fine. And so some guy sent me a thing, and he says, "Okay." He said, "So," he said, "You're a very famous investor," and he didn't even know who you were. Right? And she sells a $100 newsletter, and he wants a picture with her. So that's where the world has moved to right now. But anyway, so what's your question?
Bitcoin.
Oh.
You still love Bitcoin, obviously.
Yeah, I mean, well, I would, what was November of 17, right? November of 2017.
Uh-huh.
I would, if you want to know, that I think, Chris Davis told me that was the best letter I ever wrote in the 30 years I did this. But, so it's on our website, November of 17. When I wrote about Bitcoin, I wrote about Buffett and Diamond and Larry Fink and Paul Krugman and all these guys saying it was a fraud, it was index of money laundering, it was this or that. And so I went through and I said, basically, these are the financial, it's like the Yankees, 1927 Yankees murderers row. And, and so you got this financial murderers row, and when they're opining on things financial and they all agree that it's terrible, it's probably terrible. I said, but on the other hand, I did a different take on this, and so I wrote the different take. But I think probably the easiest way to encapsulate Bitcoin in a way that most people can understand. So I mentioned Chris Davis, and so Chris has been a friend of mine for 30 years, and was in every meeting about Bitcoin that I was in with respect to actually trying to understand it, going back to 2011, and he's never. I mean, I bought it at $200 a coin, and I think my average cost now is about $600 a coin, and he's never owned it, and it's 27,000 today or wherever it is, and he said to me once, he's like, he said, I know why you own it. He said, you consider it like digital gold, or it's like a store of value. I'm like, yeah, that's one way to think about it. And he said, yeah, but he says, I said to him, why didn't you own it? And he says, because he said, I don't own gold either. I don't own gold because it has no intrinsic value. It never has dividends, never will, never generates cash, it never has any earnings. It's just a clump there that you can look at. And he said, so that's why I don't own gold, I don't own Bitcoin. And I said, well, the objective of investing is not to own things that have intrinsic value. I said, the objective is to make money. And so you told me before, you could see that it could be digital gold, and that would mean that it would be about a $50,000 price. And it was trading at $200, and you wouldn't own it because it's not going to generate any dividends? Like, come on. So we've had this debate, and I've made no progress at all on him until recently. And it finally dawned on me about not too long ago. I said, hey, Chris, I said, aren't you an expert on insurance? And he said, yes, my grandfather was the insurance commissioner of New York. My father, with a multi-billion-dollar fund, was the biggest owner of insurance stocks. We're probably the biggest owner of insurance stocks in the country in our funds. And he said, yes, I think I do understand insurance pretty well. I said, what's the intrinsic value of an insurance policy? He said, well, you can easily calculate the intrinsic value of an insurance company. You can look at its exposure, you can look at its credit, you can look at its underwriting. I said, I didn't say a company, I said a policy. He's like, oh. And I said, you have insurance personally? Health insurance, life insurance, car insurance, property casualty insurance, fire insurance? Yeah. Yeah. I said, and you read a premium to these companies for these policies, right? He's like, yes. I said, and what do you want the intrinsic value of those to be? You want it to be zero. You don't want to have all these bad things happen to you. And it's worth it to you to basically spend money that you hope to never see a return on ever, just for the peace of mind that gives you, that you're protected if certain kinds of things happen. And I said, so, if Bitcoin, I would consider to be an insurance policy. It's an insurance policy against money printing. It's an insurance policy against a wide variety of government seizures. The guy that talked me into Bitcoin, a guy named Wences Casares, and who's from Patagonia, Argentina, and he was saying to a group, he said that you don't understand why you should own Bitcoin here in the United States, because you have stable rule of law, property rights, stable government, low inflation. He said, my family's been in Argentina for 150 years, and they're prominent, and we've been wiped out 4 different times by nationalizing the banks, inflating us away, seizing our assets, seizing our companies. Franklin D. Roosevelt seized all the gold in the 1930s. And if you didn't turn in your gold, you went to jail. So Bitcoin is the only economic instrument in the world that is where the supply is unaffected by demand. Even gold, which only grows supply about 1% a year, that's because gold is $2,000 an ounce. If gold was $20,000 an ounce, that supply would grow faster. There'd be a lot of mines that could come into production that can't come into production. There are only going to be 21 million Bitcoins ever. And there's estimated to be over 50 million millionaires in the world. And there's about 19.2 Bitcoin currently outstanding. And so if every millionaire just decided that he or she wanted one Bitcoin, they couldn't have it because there's only 21 million out there. And so what I'd said to Chris is that this is basically an insurance policy, except for the fact that unlike the insurance companies that are writing the policy, this particular, you are the owner of this insurance company. And the people that are buying Bitcoin are basically also becoming owners of this company. And it's a really cool company because it doesn't have any employees, it doesn't have any assets, it doesn't have any costs. And its value, though, it's right now valued at about $500 billion. Berkshire Hathaway, which is more than just insurance, is $700 billion. And I would venture to say, when we had that pull out of Afghanistan, Western Union stopped doing remittances in Afghanistan. Bitcoin kept it up when the pandemic hit. And the Fed had to come in and uncork the financial markets, including the treasury markets, because they all got clogged up because of lack of liquidity. Bitcoin operated 24/7, never missed a beat. Every 10 minutes, more Bitcoin are created. And so I would say that it's an insurance policy against all kinds of financial catastrophes. Excuse me. And I would venture to say that in the next few years it'll be the most valuable insurance company in the entire world. It's already close to that. And it would be difficult for me to think that it won't at some point trade at, it's already got 70,000, but 100,000, a million. If Bitcoin, the other thing interesting about Bitcoin, and I'll stop on this in case anybody wants me to keep going, is that, so there's only 21 million Bitcoins, but Bitcoins are basically almost infinitely divisible because you can buy fractions of Bitcoins, and they're called Satoshis. And so there's 100 million Satoshis in one Bitcoin. So if and when Bitcoin gets to $1 million, a Satoshi will be 1 penny. And so you can see that can be multiplicative. And I will then, I would be remiss if I didn't mention this because Heather and I were at this Bitcoin conference and we went, and Bill Ford was there, and he interviewed Michael Saylor, and who is the chairman of MicroStrategy, MSTR. And MicroStrategy owns 140,000 Bitcoins. It's the largest owner of Bitcoin in the world. And it has a cloud computing business which is worth about $1 billion to $1.5 billion and generates cash like cloud computing businesses do. And so basically all the cash that they generate, then MicroStrategy just buys more Bitcoin with it. And so we had a chance to spend, a couple of hours, Heather, with Michael Saylor at his house in Miami, and listen to effectively a monologue for about 2.5 hours on the state of the world and on the state of Bitcoin. And I have to say that was the most impressive thing I've heard since I've met Jeff Bezos and heard his monologues. And but his take on things, which I had not thought about, is that that Gary Gensler, this is something people have said, right? That Gary Gensler is at war with crypto. And that's why they forced Signature Bank. I mean, when Signature Bank failed, they stripped the crypto assets out of it and didn't let New York Community Bank buy it. When Silvergate went into liquidation, same thing, because it was all focused on crypto. And so now they're threatening Coinbase. And Gensler has said that everything except for Bitcoin is probably a security, including Ether. And Saylor's view is, and I hadn't thought of it this way, is he said they are concerned about the stability of the financial system if basically these crypto gets its tentacles into the normal part of the financial system, and they could cause a lot of damage. Plus, it's just this whole crazy stuff of these 25,000 tokens floating out there that people are using to raise capital to scam other people for stuff that's worthless. And he said, he said, Gensler's going to probably put these things out of business. He said, but the bureaucracy moves slowly. It's not going to happen fast. He said, it's probably good that it doesn't happen fast. He said, but these things, he said, so take something else. He said, so the issue here is like who's harmed by this kind of thing that's going on? He said, so for example, don't you think that, he said, Bitcoin trades 24/7, right? He said, do you think people should be allowed to buy Apple stock on Saturday? You know, shouldn't Apple trade 24/7? Like, why not? Well, because we have these stock exchanges that want to protect their franchise. And he said, so if you look and see who's being harmed by this stuff, it'll teach you a lot. And he said, now Coinbase is probably going to have to reincorporate overseas. He said, because they're going to make life miserable for them. He said, that's fine. It's a good company. It's smart people. He said, but he said, Bitcoin is the only, it's a commodity because it has no issuer, has nobody to regulate. And he said, he said, eventually when these coins all collapse, these tokens, he said, that's when Bitcoin's going to have a huge move up. And I said, I mentioned to Heather or Bill that there's actually a study by the St. Louis Fed that was done some years ago during the last boom of those initial coin offerings after 2018. And they noted that what happened was that when that's what caused Bitcoin to collapse from 17,000 down to about 3,000 at the bottom. And the St. Louis Fed said that when things like this, and they defined what this is, but that basically the total number of instruments that you have to invest in or to own that is of a like kind, it's like a money supply, right? And so if somebody owns this, they don't own that, or don't own much of that. And so they said, so when these coins go away, as they will, then Bitcoin will go way up. Those coins went away and Bitcoin went to 70,000. Now you have all of these tokens coming out again with these DeFi and Web3 and stuff like that, and NFTs and ordinals and all this other kind of stuff. There's 25,000 of them now, but they will disappear mostly. And then I think what happens is that money flows back into Bitcoin. The other thing I think happens is that Bitcoin tends to be correlated on a regression analysis basis with a variety of different things. So one of them is, growth of M2. Another one is the growth of, in essence, speculative long-duration assets. So you'll see that normally, not every day, but normally, that explains most of the move in Bitcoin. And so what I'll end on, unless you want to have some questions, but what I'll end on is that so I've actually been buying a fair amount of MicroStrategy right at these prices. It's about 200. It's down today because Bitcoin's down $800 today. So there's not going to be a spot Bitcoin ETF, in my opinion. It's not going to get approved. But you don't have to have it because MicroStrategy is a spot Bitcoin ETF right now. And as I said, it owns 140,000 Bitcoins, and it's about twice as volatile as Bitcoin. So when Bitcoin goes up, it goes up typically, not every day, but twice as much. When it goes down twice as much. And I think that, the way that Michael also runs the company, because he controls MicroStrategy, and he went through an analysis of this, because what he has is an at-the-money stock offering, continuous stock offering in registration. So as he said, so what happens is when I think that Bitcoin is undervalued relative to MicroStrategy, so then I will sell MicroStrategy stock in the open market and buy Bitcoin with it. And when it's the other way around, I won't do that. And he said, he said also, he said you can actually, I haven't checked this out yet, but he said you can actually trade our options because we have so many different instruments out there. And what did he say, Heather? By doing the short-dated options, you could make 25 to 50% a year just on the vol alone. So that's something to take a look at. So
can regulators really kill Ethereum? And it seems like overseas regulators are much more friendly to it, so it would be hard to completely kill it. But it sounds like Bitcoin maximalist view is that it's only going to be Bitcoin. That seems to be what his view is. Do you agree with that?
I think that all of these crypto assets of one sort or another will have they'll have half-lives, but I don't think Ethereum isn't going away. Mm-hmm. There's too much venture money that's basically in the DeFi stuff. It may be the case that, that there's action taken, enforcement action taken against, basically the group that controls Ethereum, to change the protocols on it as they did once before, and saying this is a security and you need to register. So that's, I think, but that's not going away.
Okay. I know we've run over, so if people have to leave, please. I do want to just allow people the opportunity if they have a question for Bill.
Much more efficient and harder to find those, or where would it be genomics or things like that that you'd be looking for?
I'll just repeat for the webcast. Is it harder to find 50 baggers? Where do you look? Genomics. How do you find them?
Well, it's never easy to find them, right? If it were easy to find them, there wouldn't be 50 baggers. They'd already be up. So I think that they tend to be clustered in things that are either perceived to be or are highly risky, right? So Fannie Mae had risk that people didn't expect when the government seized them. Or there are things where you get in an early. So Danaher, when they brought George Sherman in to run it from Black & Decker, and the Rales brothers stepped aside. I mean, he built a brilliant company by niche acquisitions, and then having an extremely strong execution in life sciences and in manufacturing and in stuff like that. Amazon was new technology, right? Google's new technology, Facebook new technology. So those tend to be the other spaces that you're in. I mean, Amazon's a $1 trillion market cap, and I think I said I've been buying the call options, right? Yeah. But that, I don't see why that isn't a double or a triple in 5 to 7 years, a double in 3 years. Just looking at the sum of the parts and where those things, when the the other thing that Amazon's going to do is that so Amazon tends to bottom when they go through these capital cycles, and so the capital cycle is pretty much over right now. And so the second half of this year, their free cash flows will start up. They have negative free cash flow last year and the first half of this year, and which is why part of the reason why they came down so much. But next year, the free cash flow will, I think, 25 billion. The year after that, probably 50 billion. And so that should go with an upcycle in Amazon stock. And it trades at around, just on a PE basis, it trades well below Costco. I mean, so it's a 23 times next year's earnings. It's trade right in line with Colgate and Coke and stuff like that. So, but it's a lot more than just a consumer products retailer or seller.
Any other question? Bill, thank you so much.
Thank
this
you.
was amazing. Thank you.
I will say, just for the record, that I am the largest shareholder in Patient, the largest individual shareholder in Patient by a wide margin, and I will continue to be.
And opportunity.
And opportunity as well.